Hey everyone, it's Sunday, January 29th, and it's time for another episode of Mayhem in the Markets, brought to you by Traderade, where we help traders and investors learn more about fundamentals, macro, and technicals so they can become more proficient and find their edge. First up, $8.3 trillion of buybacks in the last 15 years. That's a lot, and it's quite a bit more than the dividends we saw during the same period of time, which weighed in at about $5.5 trillion. Share buybacks help to drive more favorable multiples. When shares are bought back, they are taken out of the float. That leaves room for multiple compression in PE as the buybacks boost earnings per share by reducing that float. Companies that engage in aggressive buybacks, they may appear to have better earnings than they really do because of this impact. Next up, profit sentiment worsens. We can see this as analyst projections continue to be cut, and those cuts are probably not quite over yet because we're likely entering a period of an earnings recession, and there's a lot of factors feeding into this, whether it's disinflation making it more difficult for companies to maintain their bottom line, or an actual slowdown in the economy and business conditions, something that's more likely to manifest this year as the cost of capital increases, consumers continue to slow spending, and businesses continue to cut costs wherever they can. Next up, bad is good and good is bad. Bad earnings led to an average gain of 140 bips just the day after earnings was reported. Good earnings led to a loss on average of 81 bips. That's weird, right? Bad earnings cause the stock to rally and good earnings cause a bit of selling. This is the opposite of what we would expect. Historical norms are 101 bips gain for good earnings and 211 bips gain for bad earnings. So we are sort of in this upside down right now. And when we look at this sort of activity, I think it also speaks to some of the confusion in the market. Whereas there's a lot of companies that are doing really poorly, that are being bid very aggressively. Bed Bath & Beyond is a great example of that with these counter-trend short covering driven rallies, where the majority of the float is short, something like 50% or more, and yet they're headed towards bankruptcy, so people are shorting it because it's probably not going to be a going concern for much longer. Another example, this is Wayfair, where 45% of the float is short because they're likely to encounter significant trouble as their business model has some serious problems in an era where consumers are cutting discretionary spending. Nevertheless, this is a stock that's been rallying recently, up I think 17% on Friday alone. And this is not what you want to see if you believe this is a new bull market, with the garbage leading, with companies that are missing earnings having rallies and those that are being sold. These are sort of bear market types of price action that we're seeing across the board. And that's why I think it's good to just be a little bit skeptical, a little bit cautious of the latest leg of this rally. It doesn't mean it can't go further, but I don't think it's a new bull market. Netflix profit, speaking of companies not doing so well, is down 90%, really more than that, year over year, from $1.33 to 12 cents in the fourth quarter of 2021 to the fourth quarter of 2022. And this is a company that is a bit of a cash furnace, where you can see they're spending 61% of all the money that comes in right now on content costs, and it's likely to rise over time, because they're trying to become a gaming studio. They're trying to cater to multiple different geographic regions, which means making content specific to those regions in many cases. And that could have some impact on their bottom line. They may no longer stay a profitable company. The good news is if they don't, perhaps Cathie Wood can add it to ARK. Liquidity is key for stock pricing. The S&P 500 is closely tracked central bank liquidity on the way up and on the way down, as we can see. Now, why does this matter? Because it's showing us that there is a pretty good relationship between price discovery in stocks and what central banks are doing, particularly the Fed. That also tells us that as long as QT is set to run, that could provide a drag impact on stocks as liquidity is pulled further out of the market. Of late, we've had these counter-trend powerful pops driven primarily by short-term and often 0 days to expiration, or SPX options and single stock options that on average have 6.5 hours or less until expiration. Those delta squeezes are driving upward price discovery in the near term, as is an abundance of other liquidity that's being added to the market here. So let's talk about that as well. The Bank of Japan is offsetting the Fed and ECB, as we can see in blue. A whole lot of money has been coming in from the Bank of Japan, and this is offsetting the impacts from the European Central Bank and from the Fed primarily, where they're tightening. The Bank of Japan is effectively loosening by injecting so much liquidity into their yield curve control program. This madness, the inability of the Bank of Japan to get their arms around their bond market, particularly their 10-year Japanese government bond or JGB, has been the primary catalyst. They keep trying and trying and trying, and for whatever reason, maybe because people are finally realizing that a country with 260% plus government debt to GDP may not be able to pay all that debt back, they're looking at higher interest rates, because interest rates are supposed to represent the probability of default combined with a premium. So Japanese 10-year government debt trading in a range of negative 0.5% to positive 0.5% may not be pricing that in properly. I mean, of course it's not, right? Central bank intervention has completely broken price discovery and as a result yield discovery in Japan and many other countries. However, this all has been offsetting the impacts of our central bank, the European Central Bank, and in addition, the People's Bank of China and the Treasury General Account spending have added to global liquidity as well, and so that's added a bit of a buffer underneath stocks in the short term. And we could see that the Bank of Japan is buying more bonds. In some cases, they have over 100% exposure to some of these bonds, but look at these levels. The securities lending and the amount of bond purchases are both completely off the charts. This is the most on record from what I understand. And this is another visualization of all of that liquidity entering the market. And of course, it has to find a home somewhere. It's not going to just stay in bonds. It's not going to just stay in repo markets or otherwise. It's going to actually get out into the broader markets, into the US, into Europe, into emerging markets, Chinese stocks even. And so this is something to keep an eye on, I think, because if this does start to turn the other way, that is to say, if they stop engaging in such inordinate amounts of bond buying, that will take one of the pillars of support away from the equity and bond markets in the United States, Europe, and elsewhere as well. So factor outperformance this year so far has been volatile stocks like high beta, leverage, and short interest, or these stocks that are highly shorted. These are low quality factors. This is not what we want to see. Why? Because we really want to see, if we are in some kind of new bull market, which I still don't believe that we are, higher quality lead the way. Now, this is great for traders. Traders can make money in the short term on these types of counter trend pops, and I applaud all those that do. I tend to run a long short portfolio, so I tend to take profit into these types of rallies on the long side and get a little bit more short. But what I'm concerned about here is that this is a rally that's becoming a bit violent on this 0DTE index and stock option buying, and that's leaving a pocket of hot air. And that pocket of hot air is similar to what we've seen in Tesla, Upstart, Net, or Cloudflare, Asana, and Affirm before they had their tumultuous tumbles. Is it going to be different for the broader market? It certainly could be, because it's a much more complex apparatus, but I do think that the risks are growing for a fatter left tail event, and this is evidence of that. Hedge funds are also net long again, so we start to have to ask ourselves who are left to buy. They aren't as net long as they had been at some of the peaks of last year's rally, so perhaps they have a little more to go, and that would bring us to that level around 41.25, 41.30 on ES, where you've got a large high volume node. And then you also have a wall of calls at SPX 4100, so we could have a little more room to run. That might get our hedge funds up to those levels of positioning that is similar to where they were at the prior tops. And quite frankly, when we look at NAIM, we see similar in that there was a pretty big build by managed money into their allocations on the long side and out of their allocations on the short side. So we're seeing this in several places. It's not exhaustive yet, but it is telling us that we're seeing the longs get closer to running out of firepower in terms of their actual share allocations. The option situation is another matter altogether. Housing affordability is worse now than it was before the great financial crisis. So this is not a great sign, because it is starting to show some signs of improvement, but it's still way, way out of the reach of most people. This is essentially 42.3% of average or median income would be going into housing, which is just far too much for the average person to pay almost half of their income into housing. Think about that. And that's with mortgage, property taxes, insurance, all that. But at the end of the day, people can't afford that much for a house in most situations unless they're just about to get a big pay raise or something else, or maybe they have a lot of money stashed away and they're living off income and they can just sort of swing it in the short term. But lenders are also going to be hesitant to lend to folks that have so much of their income going into their mortgage and their taxes and, everything else. So I'm looking at this number with a great deal of skepticism in terms of how the housing market is going to behave this year. Some are pricing in no problem at all. If we look at home builders and if we look at some of the other construction and other related industries, everything is priced to perfection, as if there's not going to be any problem in the housing market. Which, look, I live in this country too. I would be happy if there wasn't a problem in the housing market, but we can't ignore the signs that are there. We have the worst existing home sales since 2010. We have this really poor home affordability for many. We have the cost of living in a home has more than doubled since the beginning of COVID. This is all not a good sign, particularly because you have about 50% of millennials living with family, showing that they're not able to buy a home during their prime home buying years. So I think home prices have to go quite a bit lower, appreciably lower, 20, 30, maybe 40% lower, until we really start to see a surge of demand from actual buyers and not investors trying to buy houses and rent them or otherwise. Financial conditions are far too loose for the Fed. They're back to levels we haven't seen since early 2022. And what that's telling me is that we're likely to see a more hawkish Fed in terms of looking at financial conditions and not seeing progress with their policy. They've wanted to reduce some of the wealth impacts that have created scarcity in the labor market, such that more come out of early retirement, but also so that more jobs are lost, sad as it is to say, and that less jobs are offered. And with financial conditions looser than they were before Jackson Hole, where we got the fire and brimstone speech from Powell, that tells me that unless he's comfortable with the level of inflation that seems to be sticky, which I doubt that he is, he's probably going to give us some feedback here about just what the Fed thinks about these financial conditions and how much work they probably have to do. Because if financial conditions are back to levels they were in early 2022, that suggests that the Fed is not even close to done with removing some of these wealth effects and other elements that may continue to drive demand. That is to say, if you feel you have more money, if your house is still of reasonable value, if your stock portfolio and bond portfolio is still doing well, then you're likely to continue spending on goods and services more than you would if you did not. Further, if your retirement account is flush enough that you don't have to work, then you don't need to enter the workforce and start to help take down some of those open jobs that we need. We've got 1.7 jobs offered for every one person unemployed seeking work. So these financial conditions suggest the Fed still has work to do, and in fact, some of their work has been completely discounted by the market. Money supply in real terms fell the most since 1980. This is pretty extraordinary stuff right here. It tells us that money is coming out of the system in nominal and in real terms, as we can see on the chart above. And in those nominal terms, we've not seen that in the chart at all. You can see that in the black line dipping below zero. So this is really quite dangerous stuff. What it suggests is there's not going to be enough money in the system to pay down interest on the debt. And we're seeing signs of that. We can see it in more late car loans and rising delinquencies elsewhere. In fact, auto loan delinquencies are rising to levels that we have not seen in quite a long time. This is the number of borrowers that are 60 days or more late on their car loan. It's actually higher than what it was during the great financial crisis now, and it's just as high as what we saw leading into that COVID crash. So why does that matter? Because it suggests there's a whole lot of folks that can't afford various components of their debt, and they're doing everything they can, but they're not able to pay it all. The consumer's 2/3 of the U.S. economy, so if 2/3 of consumers are struggling paycheck to paycheck and more are late on their debt, that suggests the biggest part of our economy is not doing so well. And we saw similar in the GDP data where there was not much growth, I think 0.2% in consumption. That's not a consumer that is consuming. PCE data also showed us similar, that spending is down while income is up. So this directly might impact those that are lending to car buyers, and particularly used car buyers. Those lenders might be at higher risk. And finally, this is a long shot chart, so I don't want anyone to think about this being a recommendation. None of the content on this channel is investment or trading advice, but this is a very interesting one from Incrementum. And what they're saying here, and I've heard this, kind of on and off for the last 10 years or so, but essentially the idea behind this chart is because the commodity to stock ratio has been so thoroughly beaten down, and we've seen that initial signs of a potential reversal in commodities versus stocks, that maybe we're going to revert back to where we've been, particularly during prior crises, such as the Great Financial Crisis, the Gulf War, or the 1970s oil crisis. We can also see the dot-com bubble was one of those lows in commodities versus stocks. The question is this time different. And I don't know, because like everyone else out there, I don't have a crystal ball. What I do think, though, is that commodities do have room to run higher and stocks have room to move lower, particularly as we get through this period of a bear market that will lead to the next cycle. And I think the next cycle will see commodities begin to run earlier and stocks have a more shallow bull market, because the drivers of inflation have not been resolved. We still have structural supply inelasticity in our labor market, in energy, raw materials, agriculture, and elsewhere, meaning that when we get to another area of demand growth, when eventually the Fed does pivot and the cost of debt does appreciably drop such that people can begin really consuming again in excess, there's not going to be enough supply to meet that demand. And that could lead to commodities beginning to enter a time of appreciable outperformance versus stocks. Now, does that mean it's a 9x move in that relative ratio? I don't know. Only time will tell. But what it does suggest is, at the very least, commodities may have some room to run during that next cycle. So I want to thank everyone for tuning in. Really appreciate it. If you're interested in my work, or if you want one-on-one coaching as an investor or trader to learn more about what I do and how it can help your swing trading or your investing success, reach out. You can visit me at traderade.com/mayhem, or you can use the code mayhem20 to get 20% off Traderade subscription service. We have two. We have one that's just the website, and another that's a website plus our Discord service with more real-time analysis and a whole community of amazing people. So thanks everyone for tuning in. If you like the content, like and subscribe, and you can always find me on Twitter with the handle Mayhem4Markets. That's Mayhem number 4 Markets. Catch y'all next time.